Now this next example, this company is going to sell 1,000 shares. It's common stock, but it doesn't have a par value. So that means that for whatever reason, this company neglected to establish a par value. So they sold this stock for $11,000 cash. So that opens up a question, what do? There is no par value. Well, what GAAP says about that is that if they failed to designate the par value, then whatever it was sold for, that becomes the par value. So we just simply debit cash, $11,000, credit common stock, $11,000. We have no choice but to do that because no par value is actually designated. The next example, company is going to issue 1,000 shares of common stock. There's no par value, but it does have a stated value of $9 per share. And this is going to be sold for $11,000 cash. Well, when you have a situation like this, you're really just mincing words because par value more or less is a stated value. So we will consider that that stated value is the par value. So we will debit cash $11,000. We will credit common stock $9,000. The extra $2,000 in this case goes to paid in capital. Another possibility is that rather than sell the stock for money, we could also exchange stock. If there's another company out there, and if they have an asset that we're interested in, and if they're willing to take stock rather than cash, then we could negotiate with them and perhaps have a common stock exchange where we will actually trade stock for an asset. So that's exactly what's going to happen in this particular example. So this company is going to issue 1,000 shares of $10 par common stock, but it's in exchange for land, and the land is worth $15,000. So the way we will record this, since I'm receiving a new asset, and that new asset is the land, I will debit land $15,000. I will credit common stock, but again, only for the par value, and in this case the par value is $10,000. The remaining $5,000, that goes to paid in capital. So that's the way I would record that in an asset exchange. And it could be for anything. You know, this example, it happened to be an exchange for land, but they could potentially exchange stock for equipment, a building, any asset, and many times they will do that. Then this is another example. This is a little different. In this case, this company is going to issue 1,000 shares of $10 par common stock, but it's not in exchange for land or an asset or even for cash. It's actually to settle a bill. We owe some company out there $11,000 worth of organizing costs. So we would normally have to pay that bill with cash. But if we negotiate with that company, and if they're willing to accept our stock, we could pay them with stock. So that is stock as the settlement of an expense. So we will debit organization expense, $11,000, but instead of paying for it with cash, we'll credit our common stock, again, par value $10,000, and the extra $1,000 goes to paid in capital. So that gives you an entire series of examples of all the different things that could happen whenever you issue common stock. So you could actually issue common stock at par, above par, without par, stated value, trading it for an asset, or settling an expense. So many different situations. But if you go back and look at it, you know, look at how common they were. They were pretty much all the same. You know, in every case, I credited common stock. Common stock, every single case. And I always credited common stock for what? For the par value. And if I had anything extra, that went to paid in capital. So even though these situations are slightly different, as long as you know the basic journal entry pattern, you'll be able to handle this whenever you have to do these types of entries. Now, once we've talked about issuing the stock, the next thing we need to talk about are the cash dividends. Now, remember this: the company is under no obligation to pay a cash dividend. They may, but then again, they may not. It really just depends on the success of the company. Are they making money? Do they have a lot of cash? Can they afford to pay a dividend? And so a lot of times, if they can afford it, they will pay. But some companies actually decide to keep the money that they make and reinvest it in the business. So it really just depends. But if they do, in fact, decide to pay a dividend, then we will have to record that. Now, whenever we have a cash dividend, there are going to be 3 different dates involved. The first date is the date of declaration. And on that day, we make the announcement. We declare and announce that the dividend is going to be paid, and we give everyone the details, the amount, and the other dates. But that's simply the date of declaration. And that date does require a journal entry. Then we have a date of record. Now, the reason that we have to have the date of record is because, remember, the stock is being traded continuously. Constantly, people are buying and selling and trading stock. So sometimes the question arises, who do we pay the dividend to, since the ownership of the stock is always changing? So we actually have to have a cutoff date. So at the end of the day, on the date of record, whoever owns the stock at the end of that day, those are the individuals who will receive the dividend. And then the third date will be the actual day on which we pay the dividend. And we also have to do a journal entry on that day. So we'll do a journal entry on the date of declaration and on the date of payment. We'll just make a note of the date of record. And one thing that you can actually do is whenever they declare a dividend, you could own that stock up until the date of record, then trade it to someone, but you would still receive the dividend, because as long as you owned it up to that date of record, you would still actually receive the dividend. So from our stockholders' point of view, that's a strategy that they could use, but we're the ones that are going to pay out this dividend. So to see a typical dividend example, we have a company here that has 100,000 shares of common stock, and they're going to declare a $1 cash dividend. We will declare this on January 1st. It will not be paid until January the 30th, and it will be paid to the January 15th stockholders on record. So what we're going to have to do is do one journal entry on the 1st, on the day it was announced. We're going to make a note that January 15th was the date of record, but then again on January 30th, we will also record a journal entry when it is paid. And since it's 100,000 shares, $1 per share, this is going to cost us $100,000. So now you see the actual dividend journal entries. On January the 1st, that is the day of declaration, I'm going to debit retained earnings, $100,000, and credit dividend payable, $100,000. Now, what I would say about that is the date of declaration. Now, isn't it interesting that all we did is make an announcement, and yet we're recording a journal entry? But think about this. When we make that announcement, we are obligating ourselves to pay this. So even though we haven't actually paid any money yet, it does require a journal entry. Now look at retained earnings. That is one of our 3 capital components. And we said that is the accumulated profits. So that's where the money comes from to pay for this. And notice I am debiting retained earnings to take it out. And then I show the liability, dividend payable, $100,000. And then later on January the 30th, the day that I actually pay for this, I settle the liability, so I debit dividend payable and actually pay for it with cash, so I credit cash $10,000. So those are the 2 entries that are required the date of declaration, and the day of payment. Now, in addition to dividends, sometimes a company will decide to execute a stock split. Now, why would they do a stock split? They do this for a couple of reasons. For one, it helps to control the price of a stock. And also, this can be a good way to reward our stockholders if we don't have enough money to pay a cash dividend. If you look at this stock split example, we have a company here with 100,000 shares of stock. It has a $10 par value. They have decided to execute a 2-for-1 stock split. The day before the split, it was selling on the market for $100 a share. So the question is, what does this stock split do to the stock? What effect does it have? Well, if I do a 2-for-1 split, that means that for every share of stock that was in existence, there are now 2 shares. But it cuts the values in half. So now instead of 100,000 shares, we have 200,000 shares. Instead of a $10 par value, we have a $5 par value. And instead of a $100 market level price, we have a $50 market price. So you see the effect that it has. It cuts down that market price. It regulates that price. It makes it more affordable. And all of our shareholders now own twice as many shares as they had before. And over time, if that value goes back up again, then they will profit from that. So like I said, it regulates the price of the stock, and also it helps to give our stockholders a little bit of a positive benefit if we don't want to pay out a cash dividend.